Will Shift Technologies ever become profitable? I was mentioning this company previously. Company is growing very fast, but it remains unprofitable. So let's compare revenue and operating expenses and figure out if the company has any chances to become profitable. Obviously, it's going to be very hard because the company is reselling used cars and they have to resell them for a price that should cover all the expenses and wages, and the price must be competitive. So if we look at the history of revenue and operating expenses, we can notice that operating expenses grow slightly bit slower than revenue. We can calculate operating expense ratio. It's a very common real estate analysis, but we can calculate it for any company. So in the first quarter of 2020, operating expense ratio was 1.37, and in third quarter of 2021, operating expense ratio was 1.26. If this ratio is 1, the company stops burning cash. So there is an improvement after 1.5 of a year. We can compare it to the company's competitor Carvana, and its operating expenses ratio also decreases over time. This company is very close to become profitable, and it actually makes sense because the company's revenue is growing slightly faster than the number of employees. The company's revenue increased 15 times since 2016 to 2020, but the number of employees increased 10 times. So there is more revenue per employee, and you need to spend less money on their wages to generate more revenue. But Carvana is very close to become profitable, and Shift is far away from it. Shift's market capitalization is $170 million. According to the last's earnings report, they have $250 million in cash and equivalents, a pretty big debt already, but it's nothing compared to Carvana's debt, and the amount of cash they have should be enough for this year at least, but it doesn't mean that when they are out of money the company will bankrupt. They can announce a new public offering, but the problem is that the company's market capitalization is very low, so it can hurt the existing shareholders very much. In the best case scenario, Shift will become a meme stock, and the company will significantly increase its market capitalization so it can easily announce a public offering and get enough funding without hurting the stock price too much. But I'm afraid that this is unlikely to happen. The company can also increase its debt like Carvana was doing. However, a large increase in debt means higher debt servicing costs, so it will take even more time to become a profitable company. You can see Carvana's debt to equity ratio is 9.5, but Carvana's market capitalization is $26 billion, so it can easily announce new public offerings, and the company's operating expense ratio is almost 1, so it will soon become profitable. And even Vroom seems to have lower risks than Shift because it has lower OER, lower debt, and higher market capitalization. There is a chance that Shift will be acquired by its investor Lithia Motors. It's a car retail company for like $350–500 million, but this is one of the pessimistic scenarios. So the risks are very high, but high risks mean high potential reward as usual. Thank you for listening. Tell in the comments what do you think about all this. Maybe you think I missed something. That's all.